Hey, not trying to over dominate your time, but thought I would cut in during your week if you want to listen. It's not a mandatory thing, of course. And just discuss what happened last week with the bond market. Of course, it's in all the news, etc. We don't get the bonds till later in the chapters, so we can cover all this in detail then. But I thought some of you may be curious about, on the news they talk about it was a failed buyback and it ruined the bond market and all this kind of stuff. And so I just thought I would go over some high points to kind of give you a better understanding of what it is that actually transpired and and possibly why it transpired. Now, I'm not giving you my professional opinion because I'm not a professional in the bond market, so I don't have a professional opinion. But I've done a lot of research trying to make it make sense, um, and figure out what the best way is to try to maybe explain it to y'all. And like I said, when we get into bonds, we'll talk about it at that point. But as you can see, this is today's trading. Bond markets are still down, in the red, so to speak. So it's still backfiring just a hair. Last week, to give a little history, Treasury Secretary Scott Bessent wanted to calm the surging bond market. It had all been spiking the week before. If you look at this, let me do this for you here. I think I can do this. If you look at the last month, you can see that actually it was going up and kind of spiking. As I said, it was trading pretty high. Bonds were going pretty high. Of course, interest rate they're trying to tap. They're trying to keep it steady. And of course, inflation rate is their bottom line to try to control too, because they're trying to make sure we don't have a recession and we don't also have too much inflation that we can't afford things. We're running borderline into inflation being a little too high. We're having trouble affording things. So that's where all this formula stuff comes into play. So he decided that he thought maybe he could calm the bond market by doubling a buyback. And what they do is they structurally go in every 6 months to a year and buy some of the long term debt back and then refinance it, and then it becomes new debt. And so they're looking at doing that, and they do that all the time without much fanfare. Well, he looked at trying to double what they were going to buy back, and when you kind of look at the numbers, it maybe makes it make a little more sense. So what they wanted to do was buy back $4 billion of these long-term loans. So they, instead of paying interest for 30 years, they were going to buy them back, cut back how much they had to pay in interest, and start them with new loans at a current interest rate that maybe is a little lower. So that's their thinking. Okay, kind of like when you want to consolidate credit cards and get a lower credit rate, kind of the same thing. The goal was twofold. They wanted to put an artificial demand that made people want to buy those treasuries, but then that drives, because if there's a bigger demand for bonds, they have an inverse relationship with interest rates, so it drives the interest rates down. That means the government has to pay less. A bond we will get into is us being the lender for the government to use our money to spend. And so that's what bonds are. So it's like we're the bank and they're borrowing. So that's where that comes into play. So they were hoping to kind of drive that interest rate down so they weren't having to pay as much to us back on interest. So there was skepticism that, the first 48 hours, 24 to 48 hours, it actually worked. The bond buyback statement was announced and the bond market did exactly like it should have. Some people started selling and buying and doing some things, and that kind of drove the bond prices down. But then the federal government released their numbers that they were $40 trillion in debt. So again, that's like when you're at the bank and you want to consolidate your credit cards, and they look at them and they say, well, you have 5,000 credit cards. That's great. We can put those on one. You go, oh yeah, but I have this loan at the bank that's $40 trillion. So the problem then became what they were wanting to finance was kind of small potatoes compared to the $40 trillion in debt, because they were looking at what, $4 billion and $40 trillion. They don't really add up to the same. So it wasn't really going to help our overall debt, and it was kind of like a stab in the dark of just some little pot of money, and they were trying to figure out what was going on. So people became very skeptic, and because they were getting skeptic, they started drawing back and or doing the reverse of what they'd been doing for trying to do the right thing with the bond market. So we've had stubborn inflation. We know, it's driving. They try to keep it at 2. It's been going to about 4, and then of course the bonds. If you look at the rates on this, if you look over, some of them are at 5.2, 5.6. So if you're paying interest rates which compared to your credit card rate sounds pretty good. But if you're paying, 5.2% interest, and they have to pay us that interest because we've lent them the money for 30 years, they're looking at a way to cut that interest off and cut that interest back. So this is why they thought they could maybe do that. The bond market is what funds the government, and it sets the lending costs for the entire economy. So that's the reason when the bond market blinked, and went kind of crazy, everybody kind of panicked, because that's kind of a reflection of our country and a reflection of our lending capacity and a reflection of our debt. So that's the reason it became newsworthy, and they were talking about it all the time. So bonds drive our economy. They are the largest fixed income market, so they provide a safe place for global investors, for banks, for retirement plans. So there's a lot of people invested in the bond market, because if you know you're going to get 5 something percent interest for 30 years, that's a good deal. And so people park money there that they want to keep safe. And so there's a lot of big lenders in that. It's not just you and me with our $1,000 or $10,000. There's, some big $1 million investors in this trying to take advantage of that also. So rising interest rates on bonds can signal that investors are starting to worry about inflation, heavy government spending, or that lenders, us, are going to force them to demand higher returns. So if the bond's only paying 2 or 3%, we can't demand it, but a bank might say, "Hey, if you're paying me 4%, but I'm having to pay you 7% on another loan, you need to pay me a higher interest rate." So it goes back and forth. So all that to say that technically it wasn't a complete wipeout, because they're still going to buy back some of the debt in September. I think it was the original purchase date. And so that I don't know that it's going to be a big loss by the time it all plays out, but I think it made people very aware that we have a $40 trillion debt system. We also have an cost of living going up. We have the interest rates are kind of wonky, and some are high and some are low. And just looking at trying to repay the debt, you think, how are you going to repay $40 trillion with, this buyback of four billion? It just doesn't make sense. So I think that's the reason that the bond markets all kind of freaked, and the people freaked, and it became that, because the bond is stability. The bond is a thing for our country that people look at, and if the bond prices are always pretty stable, they know our economy is stable, our country's stable, things are good. When that was signaled that we were going to buy that back, it gave off the impression that we weren't stable and we needed cash, and we needed to infuse that cash immediately, because we were going to cash those in, because when they cash them in, they have to pay them. So, it wasn't like you're going to lose your money, but then what they're doing is they're cutting off those interest payments for the next, whatever, 20 years. So by paying cash now and then refinancing them, they're going to try to secure those at a lower interest rate. And so it's kind of like that thing, like I said, when you consolidate your loans and then refinance and do it at a lower interest rate, you're looking to pay less interest and pay less over time. That's exactly what they were looking to do. And when the government does that, it kind of set off a panic bell for a lot of people. So all that together made a little more sense than just the one thing that was out there and the one thing that was happening. And like I said, they drop all these terms, and bonds have their own terms. So just bottom line is that 4 billion of 10-year bonds wasn't really going to help offset the 40 trillion in debt. So that's where people started panicking, and the market kind of reacted. So if you have questions, I know that's kind of a weird summary. Probably there's a lot more detail I could go into. But I don't want to confuse you and make it really boring. But I just wanted to give you some information. You can also, of course, Google if you have questions, or give me a holler if you have questions, and I'll try to find an answer. So hope you're having a good week, and keep on keeping on. Talk to you later.